All right, let's jump right into a huge question. How in the world do you put a price tag on an entire company? It can feel a bit like voodoo, but believe it or not, there's a whole set of rules for this. So, let's get into it.
I mean, seriously, you see a headline that a company is worth, say, $50 billion. Where does a number like that even come from? It's definitely not just pulled out of thin air. It's actually a pretty methodical process, and it all begins with one really simple, fundamental idea.
Yep, the whole foundation of a company's value starts with its assets. These are just all the things the company controls that are supposed to make it money in the future. Think of it kind of like peeling an onion. We're going to look at each layer, starting with the one that's closest to cash, its financial investments.
Now, what's so fascinating about this first layer, the financial stuff, is that how you value an investment isn't just about the math. It's almost psychological. It's all about what the company plans to do with that investment. It really all comes down to their intent.
Okay, before we go any further, let's nail down a key term, a debt security. It sounds complicated, but it's basically a formal IOU. It means a company has loaned money to someone else, and now they're the creditor. The classic example is a bond, but some preferred stocks can count too.
So here's the crucial part. When a company buys a debt security, it has to sort it into one of three buckets based on its game plan. If the plan is to lock it in a drawer and not touch it until it's due, that's held to maturity, and it just sits on the books at its original cost. Easy. But if they're going to be buying and selling it all the time, it's a trading security, and its value has to swing up and down with the market. And then available for sale is the catch-all for everything else, which also gets valued at whatever the market price is today.
Theory's one thing, but let's make this real. We're going to follow a fictional company, Maverick Co., as it buys and then sells a stock that it decides is a trading security. Just watch how the value changes and, more importantly, where those changes actually pop up.
Okay, so on October 1st, Maverick makes a move. It drops $15,000 to buy 1,000 shares of some other company's stock. Right now, the asset is on their books for exactly what they paid. Simple enough, right?
But, by the end of the year, the market's taken a dip. That stock is now only worth 14 grand. Now, here's the kicker. Because it's a trading security, Maverick can't just whistle and look the other way. It has to report a $1,000 unrealized loss right on its income statement. That means its reported profit for the year just went down, even though it hasn't actually sold the stock or lost any real cash. Wild, right? The market's mood swings hit their bottom line directly.
Then, a few months later, the stock is on a rocket ship. Maverick decides to sell everything for $21,000. So here's the pop quiz. Is their gain $6,000 from what they originally paid? Nope. For accounting purposes, the gain is calculated from the last value they reported, which was that low point of $14,000. So they actually book a $7,000 gain on the sale. This shows you just how much these kinds of assets can make a company's financial reports jump all over the place.
Okay, let's peel back another layer of the onion. We're leaving the financial world for a minute and getting into the physical one, property, plant, and equipment, or PPE. We are talking about the big stuff, the factories, the machines, the delivery trucks, all the tangible things you can actually go out and touch.
Let's use an example. Say Jayhawk Co. buys a big factory robot. Now, the initial cost isn't just the sticker price. You have to include everything it takes to get it up and running. So we add in installation and testing costs. That brings the total to a cool $1 million. But they figure at the end of its useful life, they can sell it for scrap for about 100 grand. That's the salvage value. So you subtract that, and you get what's called the depreciable base of $900,000. That's the amount of value that will be expensed over the robot's life.
So we know we have to expense $900,000 over, say, 5 years. But here's the next question. Do you spread it out evenly, or do you take a bigger hit on your profits right at the beginning? This is a strategic choice, and companies can actually use different methods depending on how they think the asset loses its value.
The simplest, most common way is the straight line method. You just take that depreciable base, our $900,000, and divide it by its useful life of 5 years. Boom. That gives you $180,000 of depreciation expense every single year. It's predictable, it's steady, it's clean.
But what if the robot is most useful when it's shiny and new? Well, you can use an accelerated method like the double declining balance. With this, you expense a much bigger piece of the asset's value in the early years. Just look at year 1, a massive $400,000 expense. This is supposed to reflect the idea that a new machine loses a lot of its value right after you drive it off the lot, so to speak.
And this chart really just drives the point home. Just by picking a different accounting method, which is totally legal, by the way, Jayhawk's year one expense could be 180 grand, or it could be 400 grand. That is a huge swing that goes straight to their reported profit for the year. The total amount over 5 years is the same, but you can see that the timing is everything.
Okay, we've covered financial assets you can trade and physical assets you can touch. Now we get to the final, most abstract layer of the onion, intangibles. These are the assets that don't have a physical form but can be incredibly valuable. We're talking about things like patents, copyrights, trademarks, and brand reputation. And here is where the accounting rules get a little weird. Honestly, if a company goes out and buys a patent from someone else, they get to record it on their books for the full price they paid. But if they develop that exact same patent themselves in-house, they can't. All the money they spent on research and development gets expensed right away. The only thing that becomes the asset is the direct cost of things like legal and filing fees.
This quote just nails it perfectly. A company could spend $500,000 inventing the next world-changing technology, and that whole $500,000 hits their income statement as an expense, dragging down their profit. The actual asset that shows up on the balance sheet is just the tiny 25 grand they spent on paperwork. It's one of the most counterintuitive rules in all of accounting.
And that brings us to the most famous intangible of all, goodwill. This is a special one. It only appears when one company buys another one. It's basically the premium they pay over the fair value of all the individual assets. It's supposed to represent all that fuzzy stuff: brand reputation, loyal customers, the secret sauce. And just like with internal R&D, you can never, ever put a value on your own company's goodwill and put it on your books. It only gets recognized when someone else buys it.
Okay, so we've peeled back the layers on financial, physical, and intangible assets. We've seen how the rules can be complex and sometimes, frankly, a little strange. But let's zoom out. What's the big picture here? What does all of this really tell us?
At the end of the day, a company's balance sheet is so much more than just a list of stuff. It's a narrative. It's a story told through numbers. The investments a company holds tell you about its risk tolerance. The way it depreciates its equipment tells you how it views its own technology. And the value of its patents and goodwill tells a story about its history of innovation and growth.
And that really leaves us with one final thought to chew on. With all these rules, all these estimates, all these strategic choices, the number you see for a company's value is this fascinating blend of hard facts and future hopes. So the next time you see a company's valuation, ask yourself, what part of this is what they have today, and what part is the story they're trying to tell me about tomorrow?